In a lot of my previous videos, I've covered the reasons why I think the IUL would be my top choice if I had to choose one financial vehicle. But in today's video, I want to focus on some of the negatives of my IUL and IULs more broadly speaking, because there are some problems that could come up when engaging with using an IUL. First off, I want to start with the one problem that applies to my specific IUL, and that is the concept of participation rate. So pretty much every other IUL carrier and every other IUL will have a number of other levers to pull on, but this is the only lever that my particular policy can pull on, and that's participation rate. So let's get into the mechanics of what the participation rate is, why it's currently positive in my policy, but there can be negatives to it if circumstances warrant it. So at the time of this recording, the current participation rate in my policy is either 175 or 180%. So in effect, this is a very positive thing because something like a 10% return would actually result in 17.5% or 18% returns as credited to my policy. And this is actually improved since I initially opened my policy. It was originally 145% as participation rate, which would have been taken a 10% return and turned it into a 14.5% return. So overall, right now it's a good thing. Now, why could this be a bad thing? Interest rates are the first major factor in what affects the participation rates in an index universal life policy. And that's because that's where the insurance companies get their low yield that they then use to purchase the call options on an index. The insurance companies don't take your funds and invest them into risky investments. They instead purchase things like investment grade bonds that return a low yield in order to use that low yield to purchase things like call options on the index funds that you're indexing against. So when the yields are down in a low interest rate environment, that means that the insurance companies have less funds to invest in the call options to get you those high gains that we use in these indexing strategies. And that's why in the current higher and rising interest rate environment, my policy currently has participation rates on the indexing strategies at 180% and 175% for the strategy that I'm using. But in a low interest rate environment, they do reserve the right to bring that down to as low as 5%. The other big factor for the insurance companies is volatility. When volatility in the indexes goes up, that means that the call options that the insurance companies purchase get more expensive. So this means that in a high volatility and low or no interest rate environment, the insurance company reserves the right to reduce that participation rate down to as low as 5%. And this would mean that a 10% return now becomes a 0.5% return that's credited to your policy. The other mechanism that insurance companies have that they can use to protect themselves in the event of a highly volatile and low interest rate environment is the concept of a spread. And effectively, a spread is subtracted from the return of the index to establish what they will credit your policy with. So in the case of a 10% return and you have a 7% spread, you might only get credited 3%. The last major mechanism that index universal life insurance carriers have is the concept of a cap. So in the event that there is a 9% cap on an index strategy and the index does 10%, then you would only be credited with 9% in that case. You might be wondering that with all of these different mechanisms that the insurance companies have at their disposal to destroy your returns, why is it that I would choose an index universal life insurance policy as my primary financial vehicle, even though I'm also doing whole life, Roth, and other types of accounts? Well, that's because if the insurance companies had to pull on these levers to the extreme that could happen, then every one of those other vehicles would also have their returns likely destroyed or be losing a lot of money as well. And in those types of apocalyptic scenarios, you're going to be losing a ton of money inside of something like a Roth or whatever else, whereas these insurance companies will at least have that contractual guarantee of 0% or minus 1%. Well, in these apocalyptic scenarios, what happens if an insurance company becomes insolvent? They'll often get bailed out by other insurance companies, usually buying them out, or they'll demutualize or do a number of things. And in worst case scenario, like in AIG's situation, the federal government bailed them out. But it's very rare that this ever even comes close to happening. And in the case of AIG, it wasn't actually normal insurance business activities that got them into trouble. It was selling credit default swaps, which was a crazy business that insurance companies should not even come close to have been engaging with. It's highly speculative, and it is not actually what insurance companies do at this point. I'm not going to get into the specifics of what went down with the situation with AIG in this video. Drop a comment below if that's something that interests you. There's plenty of content out there that you could find on that situation. But if you want to hear my take, again, drop a comment below. Now, we just talked through a number of mechanisms that the insurance companies can use to protect themselves from bad market conditions. But what is a negative that is inherent to using life insurance as a wealth growth tool? There's something we call the capitalization period. And this is the period from when you start an insurance policy to the point that it breaks even. The amount of cash value that you have in that policy is equal to the amount of cash value that you've contributed to that policy. How long that is dependent on your health and your age. But at best case scenario, you're looking at a couple of years for that to happen and where you break even. The reason for this is there are a number of costs that the insurance companies need to recoup when they issue a policy. And those include the commission paid to the agent or the medical exam that they had to do in order to put your policy in force and assess your health, and a number of other administrative costs that are involved with running an insurance company. This capitalization period of breaking even within a few years is only if you have a properly designed life insurance policy. So you can't just go to really any agent on the street or out there, or maybe somebody you know, unless they know how to design to maximize for cash value. When you go to a normal agent who sells you an IUL or a whole life policy, they're usually getting somewhere between 80 and 100% of your first year's full premium. The way that we design policies is somewhere between 5 and 15% of that first year premium as commission. So it's a huge difference in terms of the costs that need to be recouped, and that really impacts your ability to break even and your cash value. The net effect of having a poorly designed life insurance policy is that it could take 10 times as long to break even on your cash value. So it's very important that you properly design your insurance policy in order to maximize cash value. So this is the reason why these life insurance products get such a bad rap from all of these different financial gurus out there, and pretty much anybody who's talking about personal finance. It's these agents that are designing policies that are minimizing your cash value and maximizing commissions. Another factor with these poorly designed policies is that you have very little flexibility in how you're funding this. Otherwise, you might end up throwing away your money by having your policy lapse because you can't afford it. So in my case, because I have a properly designed life insurance policy and I've overfunded it so significantly, I could really stop paying premiums at any point and still have a good amount of life insurance for the rest of my life. So if you're choosing between getting one of those poorly designed policies or buying term and investing the difference, then I would say don't get one of those poorly designed policies. If you're interested in trying to get a properly designed policy, check the video description to book a meeting with us. So I hope this video was able to inform you on the real and actual downsides of permanent life insurance products, and specifically in this case, indexed universal life. Most of the financial gurus out there get this completely wrong. They don't actually understand these products. They're talking about you don't get to keep your cash value and all of these other things that are just actually completely wrong. So if you really want to learn about these things, check out some of my other content. I've got a lot of other content on these concepts. I found that there's a lot of channels out there talking about the infinite banking concept or bank on yourself or whatever you want to call this concept of overfunded cash value life insurance. And they're not talking about the negatives. There are negatives. So it's really good to understand the problems with whatever you're getting into when you're going to put a whole bunch of money into it. There's also a lot of channels out there that say that you can only do this effectively with whole life, or you can only do this effectively with indexed universal life or IULs. Well, I think both of them are wrong. This strategy can be employed with both of those vehicles, and depending on your risk tolerance and your desire for how much upside you want, you might choose one product over the other. So despite all of the negatives that I've covered in this video, I'm still personally funding my own life insurance policies, my cash value life insurance policies, very close to all of my take-home pay. And I'm very comfortable doing that because of the flexibility and the returns that I can reasonably expect. I would not generally recommend that most people do what I'm personally doing, but cash value life insurance has a place in most people's overall wealth strategies. However, there are certain circumstances, like if you're in massive amounts of debt right now, I don't recommend starting out with one of these. Check out our video on velocity banking to look into getting past that massive debt situation. Please consider dropping a like. It really helps with the almighty algorithm. We're really trying to grow our audience and put out more content that speaks to people who really want to achieve financial freedom as fast as possible. Comment below if you have any questions. We'd love to hear from you on what you're looking to achieve. And thanks for watching. We'll catch you in the next one.